Remember 2008? The world watched as giant banks collapsed, millions lost homes, and trillions of dollars vanished. Why? Because the financial system was built on layers of derivatives, paper on top of paper, without solid assets underneath. Fast forward to today. We've entered the digital age. Crypto, NFTs, algorithmic stablecoins. Some call it innovation. Others call it the second version of derivatives. And here's the big question. When the next bubble bursts, who will still be standing? That's where Islamic finance shows its strength. Asset-based, tangible, grounded in the real economy. The 2008 lesson. In 2008, the global economy nearly collapsed. The trigger was subprime mortgages, risky loans repackaged into complex derivatives. On the surface, they looked profitable, but underneath, almost nothing real. Banks sold debt to other banks. Debt became a product. Speculation built on speculation. When homeowners defaulted, the whole house of cards came crashing down. And the cost? Over $20 trillion in lost wealth. Unemployment. Foreclosures. A global financial scar. It was the perfect example of what happens when finance forgets assets. But here's the twist. After 2008, you'd think the world learned its lesson. Yet today, we're building something eerily familiar. Digital markets. Crypto tokens with no utility. Meme coins rising and collapsing in weeks. NFTs sold for millions, then worth pennies. Even so-called stablecoins can collapse overnight. Remember Terra Luna? $60 billion erased. Sound familiar? It's the same problem, speculation without assets. This is derivative 2.0, and the speed is frightening. Unlike 2008, when banks and regulators still had weeks or months to respond, the digital economy moves in seconds. A single tweet can wipe billions from a market cap. A security flaw in code can drain entire exchanges in hours. What's worse, many investors today are everyday people. Ordinary workers putting savings into digital coins because they fear missing out. When the bubble bursts, the damage won't just hit Wall Street. It will hit households directly across the globe. This is why experts warn. Digital markets may be more volatile and more dangerous than the 2008 derivatives ever were. So, why does Islamic finance matter here? Because it forces finance to stay real. If there's a property sale, the property exists. If there's a lease, the car or building is real. If there's profit, it comes from actual trade or investment. No illusions. No castles in the sky. This doesn't mean Islamic finance is immune to risk, but it does mean the system is less likely to create bubbles from nothing. Because money is always tied to something tangible. Think about it this way. In an Islamic finance model, you can't invent 10 new coins out of thin air and sell them at speculative prices. You'd need an underlying commodity, a project, or a physical service to justify that value. That grounding creates a natural filter. It slows down reckless speculation. And it builds trust, because investors know their money isn't just digital smoke. This is why, during times of uncertainty, Islamic instruments like Sukuk attract attention even from non-Muslim investors. They are seen as safer, more transparent, and tied to real assets. And in an age of digital bubbles, that discipline is priceless. What happens when the digital bubble bursts? History says it's not a matter of if, it's a matter of when. Just like 2008, trillions could vanish. Only this time, it may be faster because digital markets never sleep. And unlike 2008, central banks may not be able to save everyone. Why? Because this time, the bubble is global, decentralized, and often outside traditional banking systems. We've already seen many crashes. Bitcoin plunging by half its value in a few months. Exchange bankruptcies leaving millions of investors with nothing. Entire ecosystems disappearing overnight. Now imagine this on a larger scale. A widespread collapse could freeze liquidity, shake trust in digital innovation, and spill over into traditional banking. But here's the key insight. Asset-based finance will not only survive, it will prove itself again. During crisis, people run back to safety. They search for stability. And what's safer than something you can touch, trade, and measure in the real world? If 2008 taught us the fragility of derivatives, the next crash will remind us of the fragility of purely digital wealth. And once again, Islamic finance will demonstrate that grounding money in real assets is not old-fashioned. It's essential. Why asset-based systems hold strong. So, Why does Islamic finance matter here? Because it forces finance to stay real. If there's a property sale, the property exists. If there's a lease, the car or building is real. If there's profit, it comes from actual trade or investment. No illusions. No castles in the sky. This doesn't mean Islamic finance is immune to risk, but it does mean the system is less likely to create bubbles from nothing, because money is always tied to something tangible. What this means for the future. For policymakers, the lesson is clear. We need financial systems that build on assets, not empty promises. For investors, it means looking for products tied to reality, property funds, commodity-backed Sukuk, real partnerships. For everyday people, it means asking, what is my money actually connected to? Because if the answer is nothing, then you already know the ending. Let's pause for a moment. Why do people keep rushing into these digital assets, even when the risks are so clear? The answer is partly psychological. The promise of quick wealth is powerful. Stories of ordinary people becoming millionaires overnight with a meme coin or an NFT create a fear of missing out, what we call FOMO. It pushes people to invest, not because of fundamentals, but because they see others doing it. This behavior is amplified by social media. Platforms like X, TikTok, and Reddit can turn speculation into a movement. A coin with no real use can skyrocket simply because it's trending. And here's the danger. When millions of people pour savings into these assets without understanding the risk, the collapse becomes not just financial, but social. Families lose savings. Communities lose trust. Faith in markets erodes. Islamic finance warns against this exact psychology. It discourages gambling-like behavior. It demands that investments are tied to value, not hype. And that makes all the difference between a bubble and a real economy. Islamic finance system may shift itself to include the halal and asset-based cryptocurrencies. How it can be? Is it works well? It seems yes, because it will cover the most critical gap of cryptocurrencies, asset base and being nothing. 2008 taught us a painful lesson. Paper wealth collapses when reality knocks on the door. Digital markets may be writing the sequel faster and louder. But Islamic finance, it reminds us that money should serve people, trade, and growth, not speculation. From 2008 to today, the truth hasn't changed. Asset-based finance still wins. Thank you for watching Islamic Finance Unboxed. If you found this episode valuable, don't forget to like, share, and subscribe. And let me know in the comments. Do you think the digital market is just another bubble or a true revolution?